Hello, everyone, and welcome to this evening's session, or at least it's evening for us here down in Hampshire. Thank you for taking the time out to come and join us. And also a little apology. We suddenly, our GoToWebinar refused to cooperate. David couldn't log in, I couldn't log in. You may also have had a message to telling you to try again. So as I said, no idea why that happens, and whatever the reason, we do apologize. Anyway, let's open it up again. As always, before we can start, may I just draw your attention to the disclaimer that I know you can see on your screen. As you know, trading can be a very risky business, so please don't ever think of using money that you cannot afford to lose. As always, we are going to be looking at the US markets. We've got some stocks, we've got some commodities, we've got some general information about what's happening in the markets from a sort of fundamental sort of sentiment perspective. I think David's also, we're going to look at some indices as well. Not doing Forex. Forex is for tomorrow morning. We may make a passing reference to something like, the US dollar or the Japanese yen, but we really just want to focus on these three, the three other capital markets, the third one being the bond market. But before we start, can I just say, let me see, where are we? I need another browser over here, just to have a quick a run around to see what has been happening today. As always, investing.com is just a brilliant site because it's free and you can pick up what's happening on literally on a minute. It is live data, and as I said, for it to be free, and they practically have a chart for any market and any instrument that you can think of, and it's the quickest way to go engage what sort of, what's the sentiment out there at the moment. Well, the Dow has been down. It's kind of trying to claw its way back up again. This is the futures, and this is the actual cash market. The S&P as well, that's only down 6. What's interesting is the VIX. The VIX is actually at it's not at a sort of scary level, and in fact, I would say it's a little bit low. Would you say, David, considering where the where the markets are? With the losses that we've had today, we would have expected the VIX to be much higher. So the VIX is something that you look at because when it does start to go on a tear, then markets are in serious trouble. Generally speaking about markets, although they are slightly down, I think the Nasdaq is the only one that's actually positive at the moment, and David's going to talk about the Nasdaq as well. And I had a tweet come through saying, looking at the shape of the chart there, are we seeing a double top, or is it actually possibly starting out going to provide the base for a nice breakout? And we've mentioned it before, we do have this seasonality at the moment, and by that I mean once we've got Thanksgiving coming up. I don't think it's next week. It's very late this year. It's at the end of November, and then it's the last few weeks in the run up to the to Christmas holidays. And traditionally, it's always been what they call Santa's rally. So markets like to stay positive despite what may be going on in the background, and they will make every effort to stay elevated. Now, there is a Fed meeting in December, and we do have the example of 2018, I believe. I'm pretty certain it's 2018 when we had a pretty dramatic sell-off just before Christmas, because I think the Fed put up interest rates. And to give you a summary of what to look out for with regard to the markets generally, the markets will keel over in a very dramatic way when there is no longer cheap money. At the moment, money is very cheap, and central banks have been talking about raising interest rates, but they're only talking about raising them a very, very tiny fractional amount because inflation has come in very hot. It's at CPI is at levels not seen for I think 9 years or something. We all know things are expensive. and getting more expensive energy, fuel, stuff, everything, you name it, and it costs more than it did before the pandemic. Part of that is because of there has been a huge problem with supply, and people are, there has been also this pent-up demand. The part of the inflation has also been driven for stuff because people they haven't spent their money on the things they would normally spend because we've all been locked up. Money has been given out by governments in support, so that's also looking for a home, as it were. So it's a lot of different factors, as it were. Today, so this thing about inflation, you have to, it could actually go either way. We could see a situation where maybe we have deflation further down the line, but at the moment it's whatever the numbers are at this present time, the numbers are going up here in the UK, in Europe, and also in the States, and practically in other economies as well. So central banks have to deal with what they see in front of their eyes. How has that affected the market? Well, not really, partly because we have this seasonality. It's kind of saying, yeah, it's inflation, but we like to end the year on a high note. And is the Fed actually going to, is it really going to put up interest rates this year? And they keep pushing it back and pushing it back. So until that cheap money dries up, the markets are going to stay positive. Yes, we're going to get corrections, but people will be stepping in and possibly buying the dip. So it's a very curious time that we are living. It's been a very curious time the last 18 months or so. You don't need me to tell you. And you need to sort of keep an eye on what they're actually saying, all the members of the Fed. And today has been one of those days where everybody's been out talking with comments, etc., etc. But that's awfully interesting. That's all going on in the background, but it's the kind of background music, if you like, to what is actually happening on the charts. Right, I think we can see all the main news is out of the way. As I said, we've got various Fed speakers. I think we've still got a few earnings coming through, but all the main earnings are now done and dusted. So as I said, it's the market is now looking for, we've got Thanksgiving, then we've got Black Friday, and then we've got this rundown to the holidays. But we do have this Fed meeting. I think it might even be on, is it Christmas Eve? I'll have to look at the date. Okay, so that's my general quick roundup of what's what. Now today, what I'd like to cover, before I pass over to David, is I'd like to just go over a couple of stocks that I have been that I've picked out from Finviz. If you remember, those of you who haven't been coming before, what we have to do with stocks is obviously we have to find some kind of filtering system. I use Finviz, and I'm actually going to look at Stock Beep as well. It's a site that I mentioned weeks ago, but I haven't referenced it recently, just for a couple of points that you may like to sort of take on board and explore in a little bit more detail yourself. The parameters I have are very, very straightforward. I just look at anything that's been trading over 1 million, and I use a relative volume of 1.5. And it's the great thing about Finviz is if you come across an expression that you don't understand, you just highlight it and it explains what it's this ratio between the current volume and the 3 months average intraday adjusted. And basically it's basically the volume is 1.5 times more than you would expect, and it just tells you there's lots of activity, which is what you want for trading. I haven't looked at liquidity. Some of these stocks are small cap stocks. Possibly if at the moment, liquidity is something that we don't really, I'm not saying don't have to worry about. It's just because the market is so bullish, everybody just wants to buy. Liquidity is probably something to be aware of, but you know, just not to be too concerned. But if the market changes and changes dramatically, then your stock selection, I would say liquidity, you really do have to look at that and look at that. And by that I mean is essentially you want to stop. You look at Apple, for example. I mean, it's got millions and millions of stock, and there's always going to be a demand for it. But if you go into a stock that is perhaps very new, it's got low liquidity, it's going to probably be more volatile. But when you want to get out of it, it could be tricky. You will, but it will come at a price. Last week, I think it was last week or the week before, we looked at patterns, and one of the patterns that we looked at was using the hammer candle, and in particular, hammers don't always play out. And I've got a really nice one where it has played out. It's one that is called a butterfly network, so I'll just pull that one up. I also want to have a look at Home Depot, and I also want to look at some stocks where there have been a massive amount of volume. I mean, I am talking serious numbers that, you know, I haven't seen around for a long time, and they all came up under the auto manufacturers. They're part of the consumer cyclical. But when I was doing a quick run through Finviz, I suddenly noticed that this is consumer cyclical, and it's a subset of the consumer, and it's the auto manufacturers and auto parts. And if you have a look at them, this is LCID, and you've got RMO, but look at the volume that's gone in. I think 170, where's this one? LCID, we've got 173 million. I mean, what on earth is going on? And they are not the only ones, because this is another one, GOEV, 64 million. What the heck is? They've also been picked up by StockBeat. I'm going to have to research Fisker, GM. Look at these numbers. These are crazy numbers, and I've never sort of seen such a concentration of volume going into this subsector. It's just one of the something certainly to consider and to look at and to investigate further. And using something like Finviz, you look at the you look at the charts and you think, heck, you know, because we look at the chart, we look at the volume that's going in, and we look at what pattern has then been created by that volume. Somebody left a message on YouTube and said they had the book, the VPA book, but you know, what to do next? And the what to do next is to look at charts, is to, with or without indicators. I think you really need support and resistance indicators, because support and resistance is a huge part of VPA. And you look at charts, and what you try and do is you try and spot the VPA signals, the VPA setups that are covered in the different books. And it's only by doing that you will actually then begin to absorb the methodology, and it just becomes second nature when you look at what the candle relationship to the volume that you are seeing, that's being displayed. So another way of using Finviz, and when I said about StockBeat, which is up here, said I haven't really. Was it gone? Was it gone? Let's have a look. I seem to have mislaid it. Oh, here we are, unusual volume. There we are. Not just, where was it, GOV? I think it's dropped out. I think that's why it's fallen, but because this is updated on a hourly, whatever it is, basis. And it actually came up with, and they were all highlighted, and there are others that you can highlight, and you can see there are some stocks here that, you know, this one here is a biotech stock. It's got a relative volume of 80.6. Stock selection, selecting what to trade and what to invest, is probably the most difficult, you know, thing to get your head around. David and I, as mentioned, we are going to be putting together a stock program to very similar to what we've done with the Forex program. And this is, that element of it is possibly, or it is the most important element, because what you want is you know, you want to get to a situation where things have exploded, but you want to be in before they do so. You want to put them, be able to put them on a watch list. And we've been using chart patterns, things like a saucer pattern, things like the hammer candle, looking at combinations of candles. So that's what we'll be focusing on quite heavily in the program, along with other things as well. So before I actually go to the butterfly chart, and I've got some other charts as well, I'd also want to have a look at looking at how VPA, using VPA when you have gaps, because obviously in the with stocks, this is you have gaps, particularly around earnings. In the Forex market, you do have gaps, but they only tend to occur at the open on a Sunday if there's been a huge bit of news that's to do with a particular currency. But obviously in the stock market, they are all over the place, and gaps can be, they can be gaps, and they are traps, very much so. But if you look at the volume and what the VPA is telling you, you can make them work in your favor. And there's a really nice example on a one particular chart that I just want to bring up. Before we have a look at the charts, there's one final thing that I've not mentioned before, and it's a site I was doing. I was trawling around and looking for bits and pieces, and because I'm also doing a lot of research into putting together resources that will go into the program. This is either primarily free, maybe we'll have to also include some subscription ones, because, you know, there's only so much you can, you know, go with free. Although having said that, there's masses of information out there. And I was looking at, again, at the indices and the components of the indices, and what are the weightings for things like the Dow, the Nasdaq, and the S&P, and just refreshing my memory as to what are the top companies, because we're in this massive bull market at the moment. Everything's, everyone's going up. But what's interesting is that if you actually look, let's have a look at the Nasdaq, and this applies equally whether you are going to be trading individual stocks or even investing, or you are looking at futures and you're perhaps looking to trade an index, as it were. To actually look and get a handle on what are the weightings. So we've got 100 stocks in the NQ, the Nasdaq 100, and you go through the 100 stocks, and when you actually start doing the maths, if you look at, you've got Microsoft, Apple, Amazon, you look at the top, say the top 6, for example. Here we are. I mean, let's stop before. Let's include Google. Some that applies twice. I think Google's got 2. It's got Alphabet, Inc, and it's Google. It's those 2. But basically, it's all Google. Microsoft and Apple, obviously, and you just add them up. So you've got 11, 21, 28, 33, 38, 30. If you think about it, these are 100 stocks. The top 6 or 7 is 50% of the weighting. So what does that tell you? Well, it tells you, if you are going to trade the index, the future, and you're looking at your charts, you really do need to keep a very close eye on what these heavyweights are doing. And in fact, a lot of the data that's you know, I get through on emails and what have you, is that this heavy concentration of these moves that we've had in the markets are all down to a very narrow number of stocks is not healthy. It isn't, because we have a major correction, and you take, you know, this lot, one of these up here, it could be regulation, for example. I mean, Amazon and Google, for example, on a tax situation, and their bottom line is going to be severely dented. You can imagine that any correction is then going to be much, much more severe. From the perspective of an individual stock, you could say, well, okay, I'm down here. Qualcomm, funny enough, has had a massive influx of volume. That's only 1.325%. But what's interesting is sometimes you could, if a stock is doing really well and it's outperforming its index and absolutely going, you know, it's sort of cushioned against any dramatic reversal in the index. It's something that we're going to be looking at in more detail. It's something I wanted to explore, as I said, for the program, and I came upon this really nice site called Slick Charts, and it's free, and the data is of yesterday. It is delayed. So, but if you are trading any of the indices, any of the futures, make sure you have, you know, what these top stocks are actually doing. If you look at the Dow Jones, again, even more concentrated at the top. You've got UNH, you've got Goldman Sachs, you've got Home Depot, Microsoft again. Some companies are in more than one index, and you've got Salesforce and McDonald's. And this is very much a value, more of a value index. It's not a tech growth index, although Microsoft is, I suppose you could say, is a tech company, and it's got more sort of what I call not old-fashioned. They are more traditional. You've got Walmart, as you can see here, but again, the weightings are important. And what it also gives you, which is quite interesting, you've got the component performance. This is the performance the year to date. And what's interesting, what's been driving the markets? Yeah, sure, the Dow has been going. You've got Goldman Sachs has returned 52%. But if you look at what the Nasdaq is doing, this is where these are the growth stocks have delivered. You've got Nvidia, you've got Moderna, you've got this is where the big returns have been made. I mean, Tesla's only 50%. That's the beginning of the year. So there's all sorts of data that you can take from these indices, and again, you can go down and have a look. But it's just something to become aware of, to get to understand. I'm not talking about passive, you know, people buy index funds and what have you. And in a way, having said that, with an index fund, if your index fund is driven higher by such a small percentage of stocks in that particular index, I personally, this is just a personal view, it's a little bit worrying. You know, surely you would want to see, they're not all going to be, you know, moving up or down at the same rate and at the same speed. But for all the growth to be concentrated in such a small number of stocks is I don't think is healthy. I mean, David has got probably a view on that as well. So, right, that's something else for perhaps, you know, you would like to go and explore further. Butterfly network. I've been looking at the 5-minute charts. When I said earlier about getting to recognizing VPA. VPA is volume price analysis. We look at the price action, we look at the volume, and what we want to see is agreement, because we want to be reassured that the move that we are seeing and the entry point, you know, the move that we are seeing is genuine and it's not an anomaly and it's not a trap. And you can only do this by looking at sections of price action on different charts, on different time frames. It's easier on the faster charts because obviously the price action develops more quickly. This is just a plain chart. All I've got is the price action and the volume. So what you want to see is when you see prices maybe going lower. Well, you know, if they're going to go lower, you just have to look at little sections of price action, and you look at the volume down here. Well, you know, you've got weakness coming in here. Yes, I accept that, a reasonable amount of volume. Then you've got this little candle, and then the volume suddenly falls away. And you think, well, okay, is that going to go any lower? No, it's only, you know, it's a signal, and you think, okay, so you wait, and then the next candle comes in, and oh, lo and behold, and it goes high. We haven't got support and resistance. We don't know if that was an important support line. Well, it's a little bit of support down here, but it could have been a Camarilla level, it could be a Fibonacci level, however you measure your support and resistance. It could have been a moving average. Who knows? This is just your volume price analysis. Then it starts to go higher. Yeah, the next one, that looks quite nice. The next one is not so much, but there's a little bit of weakness at the top, but you know, it goes up, and then it starts to fall away. But you have this little candle here with a lot of volume underneath it, and you think, oh goodness, that's going to reverse. But this is what I mean by the anomalies. If that were all, if given that tall red bar down there, and that was selling, that should be much wider, because you look at a comparable bar, down bar, which is maybe that one, and you look at the spread of that one, and you look at the spread of that one, they're not the same. You say, well, okay, that's what we call benchmarking. We're always looking, you know, at what's happened before, what is happening now, because it gives us, as I said, these benchmarks, and then it carries on up again. And in fact, we get a really nice little run up. Then we get, when is this move running out of steam? And in fact, you don't even have to look at the candles. You just look at this, and you see these steps all the way down, and it does actually come to a halt. And this candle here, you think, well, that's still going up. Look at the volume, but look at the spread of the candle. You're looking at the spreads, you're looking at how they relate to the volume. Is it anomalous? Both, you know, on down candles and up candles, compare them with what has gone before, and you get this little reversal. But butterfly, the reason for butterfly is this. And we looked at hammers, and what I said a couple of weeks ago, I said it is actually quite rare to have a signal. You had this nice little waterfall. First of all, you had a period of congestion where the volume is sort of dies away. The market's not, you know, it's not doing very much. It's just moving sideways. Then we have the little bit of the waterfall, and we have the volume rising, which is what you would expect. You also then have a gap down, and you think, oh great, well that's gap down, is going to carry on lower. What happens is you have a really nice wick to the bottom of the candle, and you have a ton of volume underneath it, and that's what you want to see. If you see that, sometimes you'll see hammers and you won't see much volume, and I think there was one when there was a chart called SFT. There was a nice hammer, but there wasn't any volume underneath it, because there's no buying, there's no, you know, the buyers haven't stepped in to stop this price falling. This is what has happened, and in fact we've had an up move today. Hasn't done very much today, but it doesn't really matter, because as long as the relationship between the candle that you see and the volume underneath it is in agreement, it's when it doesn't agree. So butterfly, sort of interesting one to watch. I haven't gone into too much detail of, you know, the short interest and what have you, because I wanted to focus on the VPA. So if I just close that down, the other one I saw, this is Home Depot, which we saw was a very big constituent of the Dow. Now hopefully it hasn't disappeared. I've expanded it so you can actually see it. And where was it? Let's have a look. It's on the 3-minute chart. I think it was pretty much here. Yes, here we are. It's that one there. Pretty much here. Let's have a look. This is a little run up here. Again, we have a congestion period. Nothing much happening. A little burst of activity coming that's been picked up by the tick speedometer. David has got some information on that, and we've actually upgraded it, so we've got a new version of this, which is really, really good. And on this chart, as I said, I had a bear chart, you start with a bear chart, price action and volume, and a hugely important element of VPA is the support and resistance. We've developed our own indicators. You can do the lines, you can draw the lines yourself on the chart. We've done it because it just makes our life easier. The hatch lines on here are the accumulation and distribution indicator. It's not the same for MT45. It is the same on TradingView and TradeStation. And the amazing thing about this indicator is that each time a level is touched, and in this case is support or resistance, it gets thicker. And what that tells us is it gives us an indication of the strength of that level. If you just draw a straight line, you have no idea. I mean, you can eyeball it. You can say, well, yeah, it's touched it 1, 2, 3, 4. Yeah, that must be pretty strong. But having an indicator that actually, becomes thicker the more times it's touched, it tells you that has become a very strong level of support. When it's in congestion as well, have a look at the little down candles. Are there wicks to the bottom of the candle? That means price support is coming in. Obviously, you have price support from the accumulation and distribution. So there's obviously some buying coming in here. But then what's happening is this piece of price action at this level is actually in a channel. You've got the resistance, and it's actually thicker than the support line. But what is it that it's going to need to break out? Well, it's going to need volume, and you want to see the volume rising, and you also want to see the activity pick up as well. Activity picks up in both directions, going higher and going lower. And this is a really, really nice example. It was in this channel between very strong price-based support and resistance. We also have an indicator that gives us volume-based support and resistance that's derived from the volume point of control. The volume point of control is the fulcrum of the chart. It's what we call transacted volume at this particular level. Now this moves, this histogram here, it's not quite, this sort of goes in and out. So we have high volume nodes and we've got low volume nodes. Where you have high volume nodes, you've got more density of volume. And what happens is it takes a little bit more effort to get through a high volume node. But this is a really nice example because it does get through the resistance. You can see here the number of times that this was tested on rising volume, which is what we want to see. Up it goes. Then we have this little candle here that hits. I've actually got Camarilla on here as well. It hits volume resistance, Camarilla, and you say, okay, well, it's a really nothing candle with nothing much underneath it, and then it starts to move higher, and we have this really nice, volume coming under here, under this candle, and you say, well, it suddenly stopped, and that is because it has hit the volume point of control. The volume point of control is also of itself both support and resistance. Tesla is a really good example. On my site, let me just bring Tesla up because that explains it better, shows it. Let's have a look here. Where am I? Yes, the Tesla chart. Let's have a look because it's all annotated and it's easy to see. This is this week's analysis on it. We called it as bearish, and it did. The VPOC has now moved to the $1,000 region, but actually when it rolled over, it was at the 700 level, but I think it moved up in the last couple of days. Now it's looking underneath the VPOC, could be bearish. But what happened is under this candle, you can see there's a wick to the bottom of the candle, and I believe now it is above the VPOC. So the VPOC it's a very, very, very strong area of either support or resistance. It's an area that you will have congestion, and it will be an area from where the price will then either break to the upside or the downside. And with regard to these areas of support and resistance, what we also have to remember, as I mentioned last week, is all these levels along here around the zeros, there will be investors, traders who say, right, well, I want it to get to whatever it was there. Here we are, 394.50, nice round number. This is where I think I'm going to buy, or maybe I'm going to take profit. You know, when you look at a chart, you're obviously getting an insight into what the market makers are doing, who are managing the order flow, but there's also the psychology of, you know, the hundreds and thousands and millions of traders and investors out there who have their own view, who maybe have said, you know, well, I'm going to buy here and maybe I'm going to sell there. That's why these levels become important. So this, although there was, as I said, a lot of volume under this candle here, because it came into the volume point of control, it is, you know, you can't just expect it to carry on higher. And in fact, what happened is we did get a candle with even more volume, with a wick to the top of the candle. It hit this volume resistance. These bands that you get across here come from, are derived from the volume point of control. It hit this resistance. Could have, you know, as I said, could be profit taking, who knows, and down it goes. But what do we get in this little section of price action here? Well, we get rising volume, but look at the candle. It hits a support volume. You've also got a Camarilla level, not a, it's the R1, it's not the most important. The R3, the R4 levels are more important, but you've got a really nice wick to the bottom, and off it goes up again, and it's actually topped out, as I said, at we've got volume, the volume resistance here from the volume point of control. And these levels are then, you then use them to, well, you know, it hasn't managed to get through here despite having two wicks to the bottom of the candle and reasonable you know, volume underneath it. Why? Because support and resistance has to be, you have to incorporate it as part of your analysis with the price action and the volume. Now, where is it going? Well, you know, the obvious stopping point is back to the volume point of control. This is just a 3-minute chart. This is the kind of conversation you have to have with yourself when you look at a chart. And the conversation, it will become natural to you. And the conversation also takes away the emotional sting, you know, the emotional worry that as traders and investors we can suffer from when we have money. This is our hard-earned cash in the market, and we want to preserve it and we want to make a return from it. But what you don't want is, you don't want your emotions of fear and hope to be racked about, you know, either, as I said, by market makers, and just, you just have no idea, and you know, you get blind, you go into a blind panic. Oh well, it was going up and it was great, and oh my goodness, and now hasn't gone any further. Oh my dear, oh my goodness, you know, what am I going to do? You just calm down, take a deep breath. Yeah, it's going to have a pullback, but you know where it's going to pull back from. And then you see this candle and you think, oh, great, we've developed other indicators that help us even more, because we have the trend monitor, we have the little trend dots, we have our pivots, you know, because we want to be able to analyze charts and just we manage the emotions that are triggered, you know, in this particular game. And emotions are triggered, and David and I strongly believe that VPA, with all the elements of VPA, and we believe with our indicators, give you the best chance of being able to succeed. I've just passed over to David. If you've got any questions, then please just pop them into the chat box, and we're happy to answer them either in the chat box or on air.
The wrong button there. Hi everybody, hopefully you can hear me okay. I'll just move that out of the way. Hopefully you can see my screen. Great stuff. I've actually started somewhere completely different because this is on the 15-second chart, would you believe? 15 seconds, this is on the YM for December contract. So we're on the Dow here, Dow Jones. This is the futures contract for the Dow. And ever since Anna has been talking, which was back here, this is Ninja, so it's very easy to pick out where we started over here, 1901, 7 o'clock our time. This was just starting to shape up into a nice potential reversal low, which is actually what we got. But the reason I wanted to show you this was much more to do with the congestion phase and what Anna was talking about. I've talked about it last week as well. We had this really nice price waterfall. You've got all the VPA lessons in here that really spell it out for you when you're in a position like that, and you've got a nice bit of profit coming. Maybe you're in here up at the top somewhere, you see this little reversal, you think this is going to go far, you've got a nice candle, you've got a pivot to the top side, you've got decent volume under there. It doesn't look terribly strong, you get a repeat of it here, market's trying to rally, not looking strong, volume under here is good, it's fine. Really gives you confidence. Then you come down to this little bit here, what's happening? Okay, we've got rising volume under these three candles, which is fine, not spreads widening, spreads narrowing a little bit, so you're possibly expecting a pause point anyway. Then the market starts to rally against you and you think, am I going to close out? Is this a reversal? I've lost some of the profit that I've already mentally banked, but the volume is falling away, so you've got two candles on the up, which are pretty much identical, and you've got volume falling. So it's a nice confirming signal. It doesn't necessarily guarantee that that's what's going to happen, but it certainly gives you, as Anna said, it gives you a little bit of comfort. VPA is about giving you, it's removing some of that emotional mess that you have in your mind, the fear when you've got, and the biggest fear of all, let's face it, is when you have a decent position in the market, you're making money, you've already stuck that in the bank, you thought, great, I've made $100, $200, whatever it is, $500, $1,000, and you stick it in the bank, and then it starts to reverse, and you're suddenly from 1,000, you're down to 750, and then 650, and 600, and 550, and you think, I should have closed out. And then what happens? The market congests, and then it starts to rally again, and you're back up to 1,000, and you're out of the market, and it goes 1,500, 2,000. Typically what happens. And this is, what it's about, and it's why the indicators, you've got the trend monitor at the bottom here, which has been bright red throughout. Then we go into the price waterfall. So you're looking at this, you're wondering, you're not sure, you're not certain, but certainly that is giving you some confidence. Then you get rising volume. This is what you want to see: falling market, rising volume, big lump of volume comes in here, and then we go into the congestion phase, which is really the most interesting of all of this chart. Because, as I've said many times before, around the volume point of control, and this is 15-second, bear in mind, so it could be any time frame, but the principles are exactly the same. It doesn't matter whether you're on a 15-second chart or a 15-minute chart or a daily or a monthly. You're into the congestion phase. Now, the thing with congestion is patience. Now, in this case, obviously, it's not a big deal because we're going from where 1922 to 1934. So, with 12, 13, 14 minutes, we've got to wait and be patient. But if this were an hourly chart, or if this were a 15-minute chart, this is a lot of candles to be patient through, but you have to be patient. But what the volume point of control does also, it tends to build these very strong levels around here, the resistance and the support platforms, and they work in several different ways. Not only do they give you guides as to where the potential takeoff breakout points may be, but this whole wedge of price action also gives you a massive amount of protection if you're going to take a position. If we're going to take a position, in this case, the market broke to the upside. We had a decent amount of buying coming into that candle. We had a bit of a fake here, didn't really reverse, went back up, bashed back into the resistance again, came back down again. Then we had some stronger buying coming in under this candle. Then we started to take off. Then we got an injection of volume under this candle to really drive it away through this resistance area. Now, at that point, you might think, okay, is this going to take off? Looks as though it might do. We had falling volume there. That's a bit of a worrying sign, but that particular candle, it was tiny. It's like a little test. If you've been in the VPA book or on the program, you'll know about testing, low volume tests to test the supply and test the demand. and then on up we go. But what this gives you, what this huge wedge of price action and support gives you, it's a platform not only for the trend to develop, and bear in mind that trends develop from congestion phases, that's where they're born. But in addition to that, if you're going to take a trade here, you've got this massive amount here. It's quite narrow because it's based around the volume point of control. So if you put your stop loss below this level, assuming it meets your risk of money management rules, and let's face it, this is a 10-point range. This is pretty narrow. So if you set it under here, you know, you've got so much protection. Yes, the market starts to reverse. You might think, okay, is it going to reverse against me? It doesn't. Carries on up. Another injection of volume going in here, and on up we go, on up the chain. So I just wanted to highlight it because it is on a 15-second chart here, pulling it right the way back. You've almost got, you know, a perfect example of a nice trade to the downside, into congestion, patience, 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 and then you've got a nice trade developing to the upside. So within the space of what, I don't know, half an hour, you can be short and you can be long and you can make money both sides of the market. Now, bear in mind, if you put this particular piece of price action from, I don't know, from 1910, let's say, right the way over to 1940 or 1950 rather over here. So, you know, a half hour, 40-minute chart. If you put it on a much lower time frame chart, then what is this going to look like in terms of price action? Well, it's going to be kind of like a hammer candle because the market's up here, it's fallen, and it's recovered. Overlaying two candles on one another is very easy, but it's visualizing things like this, which really sort of cements in your mind as to what is actually going on there. Just pull that out again. So there we go. We've got a volatility trigger coming there. And really then you're just looking at, you know, how that looks on the other time frames. This is it on a 3-minute time horizon, similar sort of picture, you know, broke away from the VPOC, nice candles, decent volume under there. Then we start to get the buying to the bottom. How do we know there's buying coming in there? Well, partly through the volume that's coming in, partly through the fact that all these candles have got, generally speaking, deeper wicks to the lower bodies, deeper wick, 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 wick. So you know there has to be some buying coming in. If they had wicks to the top, then it'd be going the other way. So that's a very, very crude analysis of a candle chart, but you know, it is one of the ways of just very quickly. In other words, what is the sentiment? What is the bias? Is it more buying bias or is it more selling bias at that point? And of course, at that point, it is more buying bias. So we start to see it rally. Volume's falling away a little bit. You know, it's not looking terribly strong. In terms of where we're going to get to, if we're going to move to anywhere, then you know we're moving now up to the 35,900 level, up at the volume point of control. So in terms of jumping in now, it's probably a bit late in the day to actually grab something from that move, because there's probably only about 10 points left in it before it actually hits that particular barrier, which is always going to govern. And the slower the time frame, I've said it so many times before, the slower the time frame, that will always carry more weight than a faster time frame. So the 10-minute chart here for the YM will carry more weight than the 5-minute. The 15-minute would carry more weight than the 10, and so on and so forth. Sorry, just moving over. I just want to have a look at something over here on the other screen. Just want to see what the dollar's doing. Where are we? Where are we? There we go. Okay, the yen is pretty flat at the moment. It's been rising. It's flat. The dollar's, it's been selling off pretty much the afternoon. It's starting to rally a little bit as well. So obviously you're going to keep an eye on that as well. Let's just pop that back down. Okay, let's go over onto the multiples, see what's actually going on in terms of the other two. There we go. This is the workspace you've seen many times before, I'm sure. This is now we're on the daily at the bottom. So this is the Dow. This is what the Dow is doing. That's on the daily. And really no great surprise to see that little bit of weakness coming in, because going back to what I was saying just now, you know, the market was trying to rally the other day. It was trying to rally yesterday and fell back. You know, it's not looking terribly strong. It's got that sort of weak structural look to it again. This is the NQ. The NQ is still trying to drag everything higher. You know, we had this rally here, rolled over. Now we're trying to go up again. There's a little wick to the upper body here, trying to get up to 16.4. It's come off again. But as Anna said, you know, it's all about Santa's rally and all about shop window at this time of year and how the markets are going to end up on a positive note. This is the ES, this is the S&P 500. which is actually down a little bit. So basically the NQ is up a little bit and the Dow and the ES are down a little bit. So there is divergence, but then we've seen it many times over the last 2-3 years. It's not always the case that indices will go up together. As we've got today, there is divergence. We've got the YM and the ES are down and the NQ is actually up. Just go over onto the stocks for a moment. There we go. I've actually got TradeStation running as well down here. I've got Apple running. Actually, let me just show you something else to put this in perspective. This is on TradeStation. So what I've got down here, this is the Dow 30. So these are the 30 stocks in the Dow. And I've got them on a 3-minute time horizon. And with TradeStation, I've got radar screens. So I've got the volatility indicator set up here. I've got the trend monitor. I've got the trends. And over on the right-hand side, I've also got the volume. And really, just what I wanted to show you is the actual volume difference in terms of what trades on the primary indices. You can see up here, there's 64.5 million, 64.6 million stocks on Apple going through the volume today. And yet down at the bottom, Honeywell is not even up to 1 million today. And it just gives you some perspective on how significant the volumes are in some of these stocks. And having said that, picking up what Anna was saying about the liquidity and how heavily some of these stocks are weighted in terms of their influence. If you go to someone like where are we? This one, United Health, there we go. It's down at the bottom. So in terms of volume, it's quite interesting because the volume on that is low compared to Apple, and yet the top 5 on the Dow are that one, Goldman's, Home Depot, Microsoft, and McDonald's. They constitute something like 37-38%. So it's not necessarily all about the volume going through. It's about what weighting they constitute in terms of the index itself. It's been a really nice move on United. Just pop that up full size so you can see a little bit better. There we go. It's coming down to the volume point of control here. So what are we expecting? Congestion. We hit some reasonable levels here. It's quite difficult to see this volume down here because it's so distorted by what went over there. Just pop that out of the way. But I thought it's a really nice way of seeing how much volume we've got going through in terms of the stocks themselves, vis-a-vis how much they influence the weighting on the index. So it's not a direct correlation. What I'm trying to say is it's not a direct correlation of looking at a stock and saying, oh, well, it trades 64 million or 30 million. Does that mean that it carries more weight in the index? Not necessarily. So it's an important point, and all of these things will be aspects of trading stock markets that we will actually bring out in the program itself. Just hopping over the tab here, this is the hot list. I've got Tesla on here. Anna showed you the Tesla post we did, and really this just reflects it. This was the huge volatility candle that we had, the down day, tons of volume coming in. This is what's been going on today. And as we said in that post, there's going to be a lot of congestion around here. Tesla's actually been one of the biggest movers. This is what I've got set up on this particular time frame, or on this particular workspace, is these are the dollar gainers on the day. So these are the stocks that have gained most just on the day. It's a great filtering system. And these are the sort of tools that you need to have at your fingertips. Not necessarily at your fingertips per se, because obviously you can a lot of the grunt work of stock analysis you can actually do outside of the market time frame. We do a lot of the analysis on daily charts. You can go through several thousand daily charts quite quickly, believe it or not, just looking at the candle patterns. Anna mentioned earlier on about sources, which are one of our favorite patterns. What you're looking for is the stock that's fallen, has then bottomed out. You're looking for the accumulation by the market makers, which is going to take time. These things don't happen overnight. It's not a case of a stock collapses, the volume comes in and then it rockets up again. It never happens like that. The stock will fall. It will go into an extended period of congestion. the market makers will accumulate, and then ultimately over time they will start to move the stock away from that area, and you'll see low volume tests, and you'll start to see obviously those regions where going back to what I was saying about support and resistance areas, when you've had congestion, you've got these very well defined levels. That is when you're starting to look for stocks which are starting to gradually break away and break higher if they've been in a fall, and equally you've got the reverse in an uptrend. So that's gainers on the day. You've got, here we go, got losers on the day down there. You can click that on. And this is how fast you can do the analysis. Obviously, intraday, you've got radar screen, which is fantastic for doing a lot of the scanning work. And then you've also got this tool over here called Market Scanner, which I've got set up, as I showed you last week, I think, or the week before, with a very, very simple, let's get on there, data, edit data, there we are, edit scan. Got it set up with a very simple scan. I've got this set to a particular number of a price, and then I've got RSI above 50, greater than 50 basically. So anything on here has got an RSI down here greater than 50. There are so many ways to scan, to cut, slice and dice the data. And you know, this is the issue, the key issue when you're dealing with stock trading, whether you're trading the stock per se, or whether you're going to be trading using options. Options we will also include. There will be a huge module on options, how to use them, obviously their relationship to open interest, various tactical approaches, because options are very alluring in the sense that because of the low cost, it's a very attractive proposition to think, oh, well, I'm only, you know, it's only $30 or $50 or $100, whatever it may be, for that particular option, rather than laying out, you know, buying 100 stocks at $100 or whatever it may be, $50. They are very seductive in that sense. And that's why a lot of traders get drawn into them, primarily because they are seen as cheap. Even more so when you're trading weekly options. And the upside, of course, is that with an option, assuming you're not trading naked options, but if you're just either buying calls or buying puts, you know what your risk is because it's the cost of the premium, simple as that. So they have a lot of benefits, but they are terribly misunderstood. They are mistraded by traders because, as I say, they go in on that seductive basis of trading an option because it's $50 and, you know, I get to control all these stocks. You have to understand what goes on behind the option. It's much more complicated than that. But having said that, they have a place in the market. They are terrific instruments to trade. As I'm sure many of you know, we were trading them very, very heavily in covered calls. That's what we used to do. That was our chosen tactical approach, and it's a question of finding a tactical approach that you enjoy, works for you, and makes you money. Basically, in covered call writing, you are renting out a stock. If you have the cash to do it, it is a great way to trade because you're not trading naked, and you're also commanding a premium from the option holder. You are basically selling the call and developing. You're renting your stocks basically in that way. Let's just drop that out of the way. So that's Tesla. Where are we going? That's Apple. It's on the way down at the moment. Nice little run down there for Apple. This is on the 1 minute, 2 minute, 3 minute, and the 5 minute. Breaking away from the volume point of control up at the top here. Just pop the 1 minute. There we go. See what's going on here. This is what I mean when you get these little rallies. You're maybe short here. You know, you see this injection of volume coming in. Has the market gone anywhere? No, you've got resistance above, you've got the accumulation distribution indicator, very strong level above here, so that's nice to see. Lots of volume going into that candle. Wick to the upper body, didn't go anywhere, you know, and it's almost, well, it's more than actually double this candle. So if this candle, just picking up what Anna was saying about benchmarking, and it's what you do all the time, you know, you're looking at this one, you're trying to compare it. What am I going to compare it with? Well, I compare it to this one. You know, look at the volume on this one. You know, that's what we saw. Look at the volume on this one. That's what we saw. We had a ton of volume going in here. Is this going anywhere? No, great sign. Real load of effort going in. What's the result? Not what it should be. Volume price analysis is really about one thing. It's whether price and volume are in agreement or are they in disagreement. If they're in agreement, happy days. If they're in disagreement, start your analysis and discover what it is the market is telling you. More weakness here, more weakness here. We've got pivots to the upper body here. you know, absolutely fine. On down we go. We get rising volume, falling price. That's great to see. We're into some congestion here. We're still down to the downside. The trend monitor at the bottom here, solid red throughout. You know, absolutely rock solid confidence. Same over here. Trend monitor's red. Transitioned over to red over here as well, and even over onto the 5 minute. It's not a huge move, but certainly it. You know, there'll be traders trading that intraday, purely because of the volume that you've seen. 60.5 million going through the market, you know, is more than enough. And this is 20 cents, 30 cents, you know, more than enough to trade on an intraday basis. Yes, you could trade it through the options, of course you can. But, you know, you've got to be aware of all sorts of things with options, the time, particularly the erosion of time, which is one of the key things. And there's a lot of others as well. Just go back. I know we're over time a little bit. Where else are we going to go? That's all right. Okay, let's just go over to gold, see what's going on with gold. Bullish on gold. Let's just pop the daily chart, just move that out of the way while they load up. There we are. Bullish on gold at the moment. Had a bit of a down day yesterday, tried to rally. You know, we're looking at 1900 plus. If it gets through $1,900 per ounce plus, then, you know, we could see 2000 and beyond. And bear in mind that with all the talk and the chatter and the noise about inflation, the traditional relationship is one where gold should benefit. It's not a given, but typically that is where, once inflation starts to bite and is seen as real, and let's face it, you know, we're all seeing it. It doesn't take the brain of Britain to work out what's going on. Then, you know, gold should be a beneficiary. The key level for gold was at 1840. We've written about it multiple times. It got through that. Hopefully that will provide a platform of support for it to get on up to $1,900 an ounce and beyond. But that's where gold is right now. Oh, sorry. Drop that out of the way. There we go. And in exactly the same way, all the VPA lessons on here, it doesn't really matter what the chart is. You know, it makes no difference whatsoever. You can show me a chart without the instrument on the top. It's the principles are exactly the same. Makes absolutely no difference whatsoever. Trading on Renko is just a terrific way to trade. Just move that back down. Multiple Renko charts. I've mentioned it many times before. This was the rally we saw on the 15-second chart. This is on multiple Renkos. This is with the Renko optimizer. This is on the YM. This one's set up to 4. This one's set up to 5, and this one's set up to 8. And they are basically matching the time frames below. So this is a 15-second, a 30-second, and a 1-minute time frame. It's a very, very powerful way to trade. The Renko optimizer, I'll just reset them just to see if they're actually the right settings. 15-second. It goes off, works it out, tells me I need to be at a 3-brick size, so it was a 4-brick size before, so we just readjust that to a 3-brick size. That was the, just put that up full size. That was the move lower. Then we had the rally here. We've got the trend dots on here. The trend dots will always change first. The trend indicator, it will go through the candle, come out the underside and come to the bottom and start pushing up, pushing up. Then we get into a little bit of congestion, goes into gray, but it carries on up. More congestion. Into congestion, goes gray, comes out the other side, comes up, still going up. And the trend monitor at this point, as we transition from red into blue, it will come after. The trend monitor will always follow after the trend dots. The trend dots will change first, the trend monitor changes second, simple as that. I'll just flick this one over. This is now on 30-second. And the beauty of trading with a non-time-based chart, this is on 5 now, so this is 5 points. So this, each of these bricks here is worth $25 at $5 a point. If you're on the big Dow, it's $25 a point times 5. I'll let you do the maths. And finally, over onto the 1 minute, we'll just reset that one. So this is on 3, this is on 5, and this is on 8 now. So that's $40 a brick, which is very nice. Thank you very much. There we go. And then at the bottom here, you've got the reason we run them with the time-based charts alongside is because then you can do your VPA analysis down here, but you also got the beauty of trading on a non-time-based chart above, and a non-time-based chart will reveal one thing that a time-based chart never does, and that's momentum. Because there is no time aspect to how quickly these bricks build, they're built on a different metric. They're not built on time, They're built on how quickly 3 points go up or down in the market. So they are purely independent of time. And if the market is moving rapidly, then these bricks will form rapidly. If the market is sluggish, they will be sluggish. It's as simple as that. You never see that on the time-based chart. And that's the beauty of trading non-time like Renko and also Tick. Right, I'm going to stop there, I think. Let's just go back down onto the futures. There we are. See where we are. On the 5 minute. Okay, so on the ES 5 minute, we're right down on the VPOC, so that's not going to go anywhere fast. We're on the VPOC on the NQ, and it looks as though the YM is probably going to lurch its way back up to the VPOC if it's going to get that far. So not a great deal of price activity left at the moment, certainly from an intraday pricing perspective, certainly if you're trading indices as well. But there's always something going on in the stock market, obviously, in terms of stocks. Right, let me just wrap up very quickly. This is where you'll find all the indicators at quantumtrading.com. Got TradeStation, TradingView, which is hugely popular, NinjaTrader 7.8 and MT45. We are actually working flat out on NinjaTrader 7.8. I will show you a couple of things tomorrow. Kind of run out of time, but our development guys, our development team are just working flat out on that right now. They are updating, they're also enhancing some of the indicators, bringing over some of the things that are available in both TradeStation and TradingView, porting those across. And they're also working now on the market analyzer. So if you have the full package on NinjaTrader, you'll get all that stuff free as always. Because we will be basing the stock, much of the stock program around NinjaTrader, which is why we're working on building that up. We're working on NinjaTrader 8 at the moment. And of course, we'll have to do NinjaTrader 7 also. Just to remind you, if you've bought an indicator in the past, and we have customers going back, I kid you not, 10 years or more, who bought something in that time period, and then decide that they've come back to trading and maybe they want to upgrade to something, we give you a credit. You're always on our system. We always know what you've bought. So whether you've bought one indicator or bundle of indicators, or maybe you want to upgrade to that, or you want to upgrade to the Forex education program, or you might want to upgrade to the stock trading program when it's rolled out, you will always get a full credit for whatever you've bought in the past. There's no question about it. It's just what we always do. The other thing we also always do is when you invest in a full package with us, you get all future indicators we develop free of charge, and everything comes with a 24/7 support program, and also what was I going to say? All future developments occur. You never pay any more, basically, because all future developments, whether they're upgrades, enhancements to the platform, whatever they are, we do it and we don't charge. It is as simple as that. This is Anna's site where you'll find all the analysis. All the books are up on Amazon, both in Kindle and in paperback format, so they are all there. And you'll find there's a load of box sets down here, which we developed last year as well, and all the links to all the various sites. And that's the Forex program. And believe it or not, we have a lot of stock traders on this program now, because they have begun to realize that the Forex market sits at the heart of everything. Because if you think about it logically, when the market sentiment changes from risk on to risk off and assets are bought and sold in bulk, the first thing they have to do is to be converted to cash. And then they come out of cash and they're converted into another asset class. So all of that river of money, if you like, goes through the Forex market. And that is why, currencies are so key to sentiment and what is going on in terms of sentiment. So we have a lot of traders in there. A lot of the trading principles are common, whether you're a Forex trader, whether you're a stock trader, doesn't matter. Deep dive into volume price analysis and everything else. There's the relational aspects to it. We look at bonds in deep detail and everything else. So it's all there. So it is a Forex program. Yes, it is Forex centric, but we do have an awful lot of stock traders on there now as well from all over the world, I'm delighted to say. So that's it. Thank you very much indeed for coming along today. Hope you've enjoyed it. We will be back tomorrow in the Forex webinar, which starts at 7:45 our time. So we will see you then, bright and early UK time. Thanks very much indeed for coming along today. Hope you've enjoyed it. Hope you found it useful. See you soon. Stay safe. See you soon, and bye for now.